Great to be with you, everyone. Happy Wednesday to you. We've got quite a few slides to get through, a lot to talk about, so I'll get underway immediately. Okay, so 2020, start of a new decade. We've got some pretty obvious characteristics in markets at the moment. They're generally expensive, but interest rates, of course, are very, very low. So the alternative is pretty unattractive. Hence, we're seeing asset class prices elevated across all asset classes. We've seen markets rise despite, in past times, events that would have caused crashes just have been ignored. So, for example, a trade war between the United States and China in any normal circumstance that would have caused a crash. Korea launching missiles or testing missiles and firing them over Japan, that would have caused a crash. The impeachment of a president probably would have caused a crash or some sort of market conniption. We've just seen the market continue to rise, and that's the influence of low interest rates, which of course is something to keep in mind in future periods. Whenever interest rates go down, it's positive for asset prices. Don't ever forget that. So very quickly, I'll name some stocks today. It's not a recommendation to go out and buy them or sell them. Speak to your financial advisor and make sure that they know your financial needs and circumstances before doing anything in the market. Starting off with a quick overview of Montgomery Investment Management. We've got two teams. We've got a domestic team, which involves our domestic research and analytics team and funds management team, as well as our distribution and marketing team. And then we have a global team under the banner Montica, with an office in both Sydney and New York. So we're constantly looking for talented people. And if you know of anyone that's interested, please let us know. We're always looking for people who are smart, hardworking, and very good at picking stocks. Our philosophy hasn't changed since we incorporated the company with our first investor back in 2010, 10 years ago now. We look for high quality businesses. We're looking for premium quality companies, those that can generate high rates of return on incremental capital. We're looking to buy them when they're at what we think are fair value. If we can buy them at a discount, that's even better. Of course, buying things at a discount to intrinsic value has been pretty difficult since the GFC, and certainly since 2016. Nevertheless, we've managed to find a few things. So that's never going to change. We're always going to look for quality businesses. We always want to buy them at a fair price. And of course, we're looking for businesses that have bright prospects, businesses that we think are going to be bigger in the future and be able to sell more of their widgets at either sell more widgets or sell the same number of widgets, but ideally at higher prices in the future than they're doing today. So that's our three criteria: value, quality, and prospects. And all of the stocks in the portfolio tick that criteria. In terms of performance, the red line represents the Montgomery Fund since the inception of the fund in 2012. The Montgomery Private Fund started in 2010. And the black line below it represents the market. The blue line above represents the portfolio. So the Montgomery Fund fully invested. One of the things that you'll notice is we would have done a lot better if we haven't had the cash. So we've held an average of about 23% cash since the inception of the fund. The reason for doing that has been because we have felt that in aggregate markets have been expensive, even since the inception of the fund. That hasn't changed. We're currently about 18% cash or thereabouts, and we think that's a wise amount of money or a wise proportion of the portfolio to have in cash for reasons that I'm going to allude to today. When does the cash work? It works when the market falls, obviously, and it certainly helps us. So in this particular slide, we've captured that quarter that ended in December 2018. So not the last Christmas just gone, but the Christmas before. And you can see having cash has actually been very, very helpful simply because it provides a buffer or protection on the downside for investors. In the long term, you can see that cash has delivered some very, very beneficial outcomes. This green circle that you can see here represents the Montgomery Fund since the inception of the fund. And if you draw a horizontal line over to the vertical axis, it intersects at about 81%. If you draw a vertical line down to the horizontal axis, it intersects at about 59%. What that means is that since the inception of the fund, in any month where the market has gone up, the fund has captured about 81% of that upside movement. Now, you might think that's not very attractive. You want to capture 100% of the market's movement. If you're in an index fund, you'd certainly be able to capture 100% of the market's movement. And as I showed you on that previous slide, if we'd been fully invested, we would have absolutely trounced the market. But what having that cash does is when the market falls, since the inception of the fund, in any month where the market's gone down, we've only captured about 59% of the downside. Now you can imagine that over a long period of time, if you continue to capture, if you're invested in a fund that gets 80% of the upside and only 59% of the downside, then you are going to do very, very well in terms of overall performance, in terms of beating the market over the long run. And you're also going to, have a journey that's much more palatable than the market. You're not seeing volatility on the downside. And that's what we're trying to deliver, protection to the downside and preserve capital when markets fall. Okay, now to the meat of the presentation. What's our view over the next decade? Well, our view is pretty simple over the next decade. We think returns are going to be low. I think they're going to be in the sort of high single digits or mid single digits. And I don't think that it's reasonable to expect much more from that. And the reason why is that when you see the kinds of returns that the market has achieved over the last few years, you realize very quickly that it's not normal. If you go back 100 years, you find markets deliver something in the order of 7 or 8 or maybe 9% on average over that period of time, over a century. It's likely that that's going to be the average over the next century as well. So if the market's currently delivering 20% or 30% returns over the course of a year or 2 years, then what you realize is the market's borrowing its return from the future. So that means future returns are going to be much lower so that the average comes out at 8 or 9%. Okay, keep that in mind as we go forward. Now, thinking very quickly about coronavirus, what we know is that, look, ultimately, this will pass. Whether it lasts 3 or 4 months like SARS did, or whether it goes longer than that, I don't know the answer to that. It really does depend on the ability for countries with less ability to control their population than China to actually manage the outbreak. That will be interesting to see whether or not that happens. So the extent to which it's contained will ultimately depend on its effect on economies around the world. Nobody can really answer how successful some of those third world countries are actually going to be. What we care about is the impact on individual companies rather than the impact on economies or on the market as a whole. So there are going to be companies, for example, in the travel sector that are going to do reasonably well out of this irrespective. So, for example, Qantas, only 2% of Qantas's international scheduled flights for this year are to China. And so you can imagine that that's not going to be, coronavirus is not going to have a very big impact on Qantas unless it spreads significantly beyond China. Now, you might believe that that's a fait accompli and it's going to spread significantly beyond China, in which case it would affect Qantas. But if it's contained within China largely and it doesn't spread and there isn't a contagion, then Qantas is not going to do too badly out of this. Contrast that with, for example, with Flight Centre or Sydney Airports. Sydney Airport, 10% of its inbound travellers are from China, and they spend a disproportionately large amount of money at the high-end shops at the international terminal. And so coronavirus, even if it's contained within China, could have a material impact on Sydney airports. So rather than thinking about the impact of coronavirus on the economy as a whole, it's worth thinking about individual sectors and companies within that sector. We own a business in our private fund called IDP Education, which I'll talk a little bit about later on, and it provides education services, particularly to Chinese students wanting to study in Australian universities, you can imagine that there's going to be a big impact on that business if there are delays or deferments of those attendees to courses or students at Australian universities. If that deferment goes beyond a financial year, well, it's going to have an impact. But if it's only 1 or 2 semesters, it's not going to have as big impact. In fact, IDP announced their results and they were very, very strong, 65% better than what consensus expectations were. We'll come back to IDP education later on. So again, it's really important that we think about individual companies and sectors rather than thinking about the market as a whole. You can't use a broad brush and say coronavirus is going to affect the market and all companies in that market the same way. Okay, we think that there's reason to believe that there's good news and there's bad news. It really is a case of on the other hand. We've got low interest rates that are unlikely to rise anytime soon. And that's because central banks have backed themselves into a corner largely. What central banks are trying to do is lower rates to incentivize businesses to invest. Businesses then invest by employing more people, or by investing, they coincidentally employ more people. But unfortunately, what's actually happening now is businesses are being incentivized to invest with lower rates, but they're investing in technology that displaces labor. So that's a negative. So that's another on the other hand. So low interest rates, good. We think the US economy is doing reasonably well. There's no signs of inflation. Employment is strong. We think that those conditions aren't going to change anytime soon. And so there's no reason to expect a recession in the short term in the United States. But on the other hand, valuations are extremely expensive. As I've got here on the slide, the ASX 200 industrials, excluding financials, is at 28 and almost 29 times, which is a record. The length of time since we've seen a correction in the market has been very long. So we're sort of at the mature end of a bull market. And as we'll see in a moment, there's been there's a bubble in private equity, and that has consequences for the stock market, which I'll explain in just a moment. The next decade says to us that, and when you take PE multiples for the US market and PE multiples for the Australian market, they imply low returns going forward. So conditions look good generally, prices are generally expensive, and that implies low returns. But those low returns are still better than cash, and so there's still a net migration towards equities and assets other than cash. And that's going to be supportive for equity prices. With the caveat, of course, that a black swan event doesn't come along and disrupt things. And that could yet be coronavirus. We just don't know. Here we've got the ASX 200 industrials excluding financials. So putting the PE into historical context, and you can see that it's expensive. There's no doubt about that. It even exceeds the market before the GFC, before the global financial crisis. So what this does is it sets a really demanding bar for companies to deliver on their earnings growth. If they don't deliver on their earnings growth, then they get hit pretty hard, and we might see that in a couple of slides' time. In the US, the CAPE ratio for the S&P 500 is at a level of 32.05, which has only been exceeded once before since 1870. And that was just before the tech wreck, the 1999, early 2000 tech boom, which subsequently bust. This chart, and Robert Shiller, who invented this particular ratio, admits it's not very good at predicting crashes. It's not designed to tell you that the market's going to crash tomorrow or next year. What it is very good at, though, is explaining what the next decade's likely return is going to be. And if you remember, a fundamental rule of investing is the higher the price you pay, the lower your return, then paying this kind of PE ratio implies a low single-digit return for the next 10 years. The question that remains is, if you're locking in on a long-duration asset a low return, will that be accompanied by high volatility or low volatility? And we think volatility is likely to be higher. One of the reasons for expecting that is that there's not good value in the market. So generally speaking, as we just showed, markets are expensive, but rates are low. So it's kind of fair that markets are expensive when you've got interest rates at historic lows. However, if you want to get a safe, high return, stocks need to fall. And so what this chart shows is for 4 different companies, how far the stocks need to go down in the red bracketed numbers, how far they need to fall in order for you to get the return on the horizontal axis. So if we just take, for example, Woolworths, which is the light blue second from the bottom curve, you can see that if you use a discount rate of say 8.5% or thereabouts, Woolworths share price needs to decline 22% to give you a return of about 8.5%. In other words, if we value Woolworths at 8% or 8.5%, using a discount rate of 8.5%, saying that that's our required return, the share price needs to go down about 22%. If we apply the same logic to Cochlear's share price needs to fall 51% to give us an 8.5% return. Another way of thinking about this is that at current implied rates, which is the horizontal line of 0, the break-even line, if you look at where each company intersects that line, that's what the implied return is from its current price. In other words, Cochlear intersects at about just under 6% or just over 5%. So in other words, the market price is implying a return of about 5%. So what you've got to ask yourself is, do you want to invest in a stock market that can fall 50% for a 5% return or a 6% return? That's what this chart is saying. You're accepting very low rates for what is traditionally a high-risk asset class. Stock markets can fall. And while they haven't fallen much in the recent past, that doesn't mean that they won't in the future. If you look at this chart here, so far 59 companies have reported this reporting season as at yesterday's close. And what this shows is some of the falls for companies that actually issued negative trading updates during January. And so look at, Nearmaps, for example, or Treasury Wine Estates or Kogan over on the left-hand side. They've had one-day share price falls of up to 40% or nearly 40%. So volatility is a reality in the stock market. And I wonder whether or not it's logical to accept low returns or low implied returns when volatility can be so high, when risk can be so high. So just keep that in mind. The future for volatility might look very different to the recent past. Here's another source of potential volatility. Here are 3 charts related to private equity investing. What I want to show you is that we've seen a boom. We'll start off looking over on the top right-hand side. What that shows is the number of private equity firms willing to take your money to invest in startups, for example, venture capital, and private equity, businesses that aren't listed that may one day list. And of course, there's a lot of high technology in there. There's a lot of AI. There's a lot of 3D printing. There's a lot of platform development. There's a lot of online retail. There's electric vehicles, autonomous vehicles. They're all the sorts of companies that private equity has been investing in. And there's been a boom in the number of companies willing to take your money and invest it in these startups. Consequently, over on the top left-hand side, there's been an increasing number of deals being done. So deal volume has risen. Then if you look over on the lower right-hand side, and I'm getting you to jump around deliberately to keep you awake, the multiple at which the valuation that these deals have been done, or the multiple these deals have been done, have been going up. And no wonder, because there's such a large number of private equity firms competing to invest money in these startups, the prices they're willing to pay for them has been rising. And that leaves us with, I think, the most important chart over on the bottom left-hand side. You know that markets are expensive at the moment. I just showed you that with these slides here. This one, you can see the CAPE ratio, the PE ratio, cyclically adjusted PE ratio for the S&P 500, sitting now at 32, and for Australia sitting at over, it's now, well, here it's about 26. So for the industrials index, ex-financials, is about 28.9. So we know markets are expensive. And if we look at this lower chart on the chart on the lower left-hand side, that's the public equity markets down the bottom, the market cap of public equities. So you can see that down the bottom on the left-hand side. But look at private equity net asset values or market capitalizations. It's a multiple of the public market. In other words, it's even more expensive than public markets. Now, here's an interesting thing. Ultra high net worth investors and high net worth investors have invested their cash in private equity because they haven't wanted to keep their cash in cash, in term deposits. And the reason why is because returns have been appalling in cash. And if you can make a lot of money, or there's a hope of making a lot of money in private equity, and people before you have made a lot of money in private equity, well, that's what you're going to do. So high net worth investors and ultra high net worth investors have been able to access private equity and invest their money in private equity, causing this bubble in private equity valuations. But who do they sell these assets to when it's time to list these assets? So when these startups decide to IPO on the stock market, well, if the world's high net worth and ultra high net worth investors are now in private equity, they've already invested in these companies, they're not going to buy it from themselves at an even higher price. Consequently, they're not going to be able to get out, not at the price that they want to get out. Private equity is an incredibly illiquid investment class. So what happens in the event that there's a left field event, a black swan, and everybody wants to get out? Well, I remember in the GFC, I was investing professionally during the GFC, and I can remember that investors, a lot of funds closed their doors. They didn't allow redemptions. They became illiquid, just like private equity is illiquid. So what they did is they took money out of those assets that were liquid, and that's the stock market. So if high net worth investors have put money into private equity and they can't exit, well, they're going to be selling any assets that they've got, any shares that they've got in the stock market. So when you combine expensive valuations in the stock market with even more expensive valuations in the private equity market, you get a recipe for volatility. And that's what I want to leave with you, that accepting low returns on equities or low implied return on equities from investing in indexes, for example, because indexes are expensive, and not expecting volatility in future years, I think is just taking on, unexpected consequences. You're accepting consequences that you haven't anticipated. So keep that in mind. If we look at resource companies at the moment, and I know BHP has just produced a great result. It's not being affected by coronavirus at the moment. Of course, if China continues to slow, that's going to be an issue. But this chart over on the left-hand side puts BHP, Vale, Rio Tinto and Fortescue in perspective. They're making huge margins. The gross margin is represented by the difference between the top of their blue bar and that red line. That red line represents the current price for iron ore, and the blue bars represent their cost of production. And you can see that current iron ore prices, they're making huge margins. But the question is, are those high iron ore prices likely to continue? We've seen recently, because of production cuts in Brazil and supply shocks in Brazil, we know that that's caused the stronger iron ore price. But if we see supply coming back online out of Brazil, well, it's quite likely that the iron ore price continues to fall. It's fallen because of coronavirus in January. It fell about 15%. It could fall further, and if it does, those gross margins for resource companies are likely to come down. And that means resource companies may not look as attractive as investments in the future as they have in the recent past. We think about banks. Banks, the prospect for banks for the next 5 years, and I've been saying this for the last 2 or 3 years, is not going to be as good as the 5 years prior. And why? Well, we know that we've got a slowing economic backdrop in Australia. We know that's a fact. That's got negative earnings outlook or credit growth consequences for the banks. We also know that there's a strong possibility of what we call a credit event. We know there's record amounts of household debt. We know there's record amounts of consumer debt. We know there's record amounts of car loan debt. We know there's record amounts of afterpay debt. And so consequently, there is the risk of a credit event. A credit event is a default or a large number of defaults or delays to payments. And that happens when people lose their jobs. It happens when people are finding it, their salaries aren't going up as much as consumer prices. And there's a risk that could happen. We've just seen, for example, Holden pull out of Australia with massive consequences for probably 5,000 or 6,000 people in Australia and their job prospects. So, it's not risk-free. The idea that the economy just plods along and people, continue to pay down their debts and continue to spend money at the shops. We know retail sales are struggling at the moment, even though some retailers have reported results that have been strong. Others have reported results that have been weak. So for the banks, there's a credit growth issue. So that's a revenue issue. And we also know that there's a strong possibility of a credit event. From an expense perspective, we know that their remediation payouts from the Royal Commission have been large. And we also know that compliance costs, which are permanent, even though the remediation costs are one-offs, the compliance costs are going to be permanent, and that's going to be an issue on the expense side. We also know this credit cycle, there's an increased probability, as I mentioned a moment ago, of delinquencies, and that could happen at the same time that bad and doubtful debt provisions are at historic lows for the banks. From an investment perspective, we think returns on equity for the banks are going to be under pressure for the reasons I've just explained. We think there could be rising bad and doubtful debts and therefore flat earnings for the banks, and that's going to put pressure on their dividend payouts. None of those things are going to change over the next 12 to 18 months, and therefore we think growth for the banks over the next couple of years are going to be harder than they have been, or it's going to be more difficult and more challenged than it has been in the recent past. So in our private fund, for example, and in the Montgomery fund, our weighting compared to the index weight, the big four are 27% of the index, but we've currently only got a 4 or 5% weighting to the banks at the moment, and we're holding Westpac at the moment. Why? Because we think because of all the bad news that's been out about Westpac, and you can see some examples down the bottom of this slide, we think it's trading at a significant discount to our estimate of its value. Even though we think the CBA is a stronger bank and a better quality bank, we don't think it offers the same value as Westpac. And so we think on balance, Westpac offers the best opportunity. Thinking of the Australian consumer, which I mentioned just briefly a moment ago, what we know is that there has been a little bump in income growth, but we know also that consumption has slowed. What does that mean? It means that people are paying off their debt. And when we do our channel checks with the banks, that's exactly what they're telling us. They're saying that, the system growth in mortgages, for example, has been slowing dramatically. And that's because the amount of new mortgages written has recently been slower than the rate at which existing mortgages have been paid off. And so we're finding that the savings ratio has increased materially. And what we're finding is that people are spending less at the shops, and as mortgage rates have been coming down, people have been maintaining their payments on mortgages, and consequently those mortgages have been coming down more quickly. So what you can see down the bottom here is negative personal credit growth. So people are spending less at the shops using credit, and that's certainly been evident from companies we've spoken to in the retail space. So it's an interesting picture. A little bit of earnings growth, not a lot, but a little bit of salary growth. But that's not going into the shops. People aren't spending money on travel. They're not spending money as much on clothing, for example. They're not spending as much money at department stores. They're paying off their mortgage, generally speaking. Then you look at volume. You look at retail volume. What we find is that in the September quarter, retail volume actually went negative. Now, in the December quarter, we found that has bounced a little bit, but nevertheless, the trend hasn't been good for quite a few years. And so we're seeing an increased number of companies go to the wall and declare, they're going to liquidation, or administrators are being appointed in voluntary administration situations. And there are some examples that I've listed there for you. But is that all bad news? Is there any good news on the horizon? Do we think that the market is potentially focusing on the bad news and not thinking about the good news? Well, yes, we do think there are opportunities in the market. We think there are always opportunities in the market. The key is to find the highest quality, lowest risk opportunities and to buy them if they're reasonably priced. What we know now is that prices have rebounded strongly on housing. So that's the first, if you like, green shoots. And I don't think that's going to change anytime soon. Don't expect a pullback in property prices anytime soon. I think the strength that we've seen is going to continue now. I was bearish on property since about 2015. And since 2016, property prices have been falling. But property prices since the election last year, I turned bullish and prices have continued to go up. And I don't think that's going away anytime soon. That's going to improve people's feeling of wealth. The wealth effect will be positive, and so sentiment towards residential property will improve. We've seen a bottoming in approvals, and I'll show you the chart of that in just a moment. So if approvals have bottomed, we're going to start to see more construction activity, more renovation activity. That means we're going to see tradies, which make up a very large part of the population. Construction workers in Australia make up about 9.6% of the Australian workforce. Residential construction is about 3.6% of the Australian workforce. So if they're getting more work, if their order book and their pipeline's starting to pick up, then they're going to be feeling more, optimistic about their prospects, and they're going to spend more at the shops. They're going to spend more on cars and utes. And we're going to see that filter in eventually into other retail spending. So we think that there are early signs of improvement in the Australian retail landscape. And here is the chart of residential building approvals from UBS. And you can see that big drop in approvals, which we have been talking about since about 2016. And it finally arrived, and that meant that there was a big drop. That big drop in approvals meant a big drop in construction activity and a big drop in housing confidence. That's now starting to turn around, it appears. Look, it could turn down again, but I don't think it's going to. I think property prices are going to continue going up for the time being, and that's going to filter through to more building approvals. And again, for the reasons I've just described, ultimately benefiting the retail sector in Australia. So who might benefit potentially from that? Well, companies like realestate.com.au and Domain, obviously with more listings, people looking for more houses and prices increasing, that will draw out more vendors, and so we might see those companies benefit. I should disclose that we own REA in the Montgomery Private Fund, and we also have looked very closely at Domain as potentially being a cheaper version of REA. We don't think it's as high quality as REA, but if it's significantly cheaper, it might be worth looking at. On the retail side, Adairs, Harvey Norman, Flight Centre and Webjet, potential beneficiaries of the thesis that I just gave you. REITs that are in the retail consumer space, so Mirvac, for example, are going to benefit from more residential construction activity. Stockland are going to benefit from having shopping centres. And then if you look over at building materials, directly benefiting from an improvement or a bounce in building approvals, James Hardie and CSR are a couple that might be worth looking at. Again, I'm not suggesting you go out and buy these, but suggesting you might want to think about whether the thesis is right and conducting some of your own due diligence or speaking to an advisor about the appropriateness of an investment in these companies in your portfolio. Highlighting a small cap company that we really like, and after I started thinking about presenting, we own this company. I should disclose we've owned it for a while. After I thought about presenting this company, it reported its results, and they were extraordinary. Its NPAT, at the NPAT line, it exceeded consensus expectations by 65%. Consequently, its shares, which had fallen amid the coronavirus fears, it bounced about 30% on the day. Now, what does IDP Education do? Well, it provides the IELTS program, which is the International English Language Test. And so if you're a foreign, an alien, if you like, and you're looking to move to Australia or Canada or the United Kingdom, or you want to study in those countries, then, and particularly if you want to become a citizen in those countries, then you need to sit the IELTS, the International English Language Test. And IDP Education provides that test in partnership with the British Council. So that we know more and more people, as they become wealthier in particularly in Asian countries, want to move to Australia or move to Canada or move to the United Kingdom, and that trend's not going anywhere anytime soon. Indian nationals in increasing numbers want to move to English-speaking countries, and this company has reported, which surprised the market a great deal, has reported very strong numbers or applicants from India. The other thing that this company does is place people in universities, and the coronavirus outbreak is having a big impact. The longer it lasts is having a big impact on the ability for students overseas to attend university in Australia and Canada and elsewhere. The longer that lasts, the bigger the impact will be. However, if the coronavirus outbreak is contained, then what we'll find is that ultimately these students aren't going away unless coronavirus causes an increased number of deaths among students. What we're actually going to find is that ultimately they're only going to defer their desire to move to English-speaking universities or study abroad. It's not going to kill their desire to do it. It's only going to defer it. And so we think that the prospects for this business are ultimately going to be very good. And the big boost is going to come from their purchase of their digital platform and what was a business called Hot Courses. They've invested a great deal of money in their digital platform. There was a lot of CapEx involved. The market was pretty skeptical about whether or not the acquisition would work, but it's working in spades, and we saw that in the results. The company actually reported 40%, 30, 40, and 50% increases in applicants, in students, in new inquiries, and basically their pipeline is growing at double-digit rates, and ultimately that will feed through to fees for IDP Education. We think that the numbers that were disclosed in the recent half-yearly report, particularly the increase in people inquiring, people coming onto the digital platform, and then attendees to universities, we think those numbers are going to continue to increase at high double-digit rates, and consequently IDP Education is going to, and I can see I've put the numbers there for organic traffic increases. Again, this is the digital platform, their qualified leads and so on. We think that's going to translate to potentially 20 to 25% growth annually for the next 3 to 4 years for the company. So that's one to spend some time looking at. It isn't as cheap as it was when we bought the stock, but nevertheless, we think there's going to be good growth out of this company in the future. Okay, I've left some time for questions for Q&A now. I hope I've covered some material that you wanted answers to. I'm happy to use the next 10 minutes with Josh to answer some of your direct questions, and look forward to hearing those now.
Thank you very much for that, Roger. We've had a stack of questions come through. We won't be able to answer all of them, but I will pass them on to Roger and his team, and perhaps they can follow up with you directly to anything that isn't answered here today. Okay, so the first question I have here, Roger, is what are your views on the infrastructure sector?
Well, I should say, so the question is, what do we think about infrastructure? So it's, I should disclose, we own Atlas Arteria, we own Telstra, we own Spark Infrastructure, which is the equivalent of the NBN in New Zealand. We own Transurban. So we've got infrastructure assets in the portfolio. As long as interest rates remain low, these assets will be supported in terms of price. And of course, some of them are going to benefit from indexed income increases. Income is highly, highly demanded at the moment, especially when interest rates on term deposits are, virtually nil, 1.5% or 1.6% in Australia on a, 60-day term deposit, and that's an annualized rate. The desire for income, and particularly income growth, has never been greater. And so we think these businesses will continue to be supported in terms of price because of their, in many cases, their index growth or growth in systemic growth in their business model. So we do like infrastructure.
Another question that came through was around your theory on cash levels of funds and what is the maximum that you'll go.
So what is the maximum on our fund? So in the Montgomery Private Fund, which is an invitation-only fund with $1 million minimum, we can go to 100% cash in that fund. Now, in a bull market, cash is the only thing cash is good for is dragging your returns behind the market. There's no point, it's not desirable to have cash earning, 1 or 2% when the market's going up 20% a year. But of course, markets don't go up 20% a year forever. Cash becomes very valuable when no one else has any. In fact, cash is most valuable when no one else has any. So in the private fund, we can have 100% cash, or about 18% cash or 19% cash in the private fund. In our retail fund, the Montgomery Fund, we can go to 30% cash. We're currently about 18% cash there. I always like to have more cash because it gives you flexibility and it gives you ability to take advantage of opportunities when the market has a very frequent habit of overreacting to something that is short term. The market treats that which is temporary as permanent, and it does it very often. And we saw that when Telstra traded at $2.70 or thereabouts. We were buying shares in Telstra at $2.80. Our average price is just a little over $3. We've seen it so many times when the market reacts on the downside. We saw it with IDP Education really recently because of the coronavirus. So when the market treats that which is temporary as permanent, you get the opportunity to buy things cheap. So I like to have a lot of cash for that reason. But of course, the corollary of that is that it's a drag on your return, so you don't want to have too much. Hopefully I've answered that reasonably comprehensively.
The next question I have here, Roger, could you give your thoughts on EML and their results out today?
No, I can't because I'm on the road and I'm here giving presentations and meeting with planners in Melbourne. So I haven't seen the result. But Gary Rollo and Dominic Rose, who own EML in our small companies fund, would be able to answer that question for you. So I'll take it on notice and we'll answer that one directly for you.
And one final question to round out the webinar. What do you believe the correlation between the rise of private equity firms versus the reduction in traditional sources of finance lending?
Yeah, it's a great question. You know, equity is patient. Equity takes the same ownership risk as the founders. Um, so there's a lot of positives for the company, but then it might not be a positive. Remember, you rank behind secured debt when it comes to winding up a company. This equity, these low interest rates, have fueled a misallocation of resources. Investors have put a lot of money into equity, into startups that employ thousands of people, but they only employ thousands of people because they can afford to, and they can only afford to not because they make any money. Some of them aren't even generating revenue. They can afford to employ thousands of people because people have supplied the equity. My question is, what happens to all those employees when the equity tap turns off? I think that could have serious consequences for the economy down the track. Your question wasn't about that, though. The question was equity versus debt. Well, I think, people are taking on a lot more risk providing equity to startups than they would if they were providing some sort of secured finance. Hopefully that answers the question.
Excellent. That was the last question we'll answer for the webinar. As I mentioned earlier, I will package up these questions and ship them over to Roger and his team to respond directly. Well, that concludes